Welcome to the Basic Tax Course Session 1 Quiz Review. Throughout this course, at the beginning of each session, we will review the most frequently missed questions from the previous session's quiz. Let's go ahead and start with number 1. John, age 50, is single and a citizen of the United States living in Canada. In which of the following circumstances must John file a tax return? A. John's income is $9,750. B. John is not required to file because he did not live in the United States. C. John's income is $9,800. Or D. Both A and C. In this question, D is the correct answer. U.S. citizens and residents living in the U.S. or living abroad are subject to the same filing requirements. Question 2. Jack, age 62, is married to Betty, age 61. Betty is legally blind. Jack and Betty are required to file a federal tax return in which of the following situations? A. Their joint income is $19,500. B. Their joint income is $20,150. C. Their joint income is $17,000. Or D. Both A and B. The correct answer is D, both A and B. Let's take a look at this. Filing requirements have several components. The first one is the standard deduction. The second one is an exemption amount. In this question, each spouse has their standard deduction amount of $5,950 plus their exemption amount of $3,800. If you add those together, it totals $19,500. $19,500. This is the least amount of income where Jack and Betty would be required to file a federal return. So A, $19,500, and B, $20,150, both meet this minimum amount of $19,500. Let's go on to question 3. Sally is self-employed and did not receive a Form 1099 miss. Gross receipts for her business were $5,000, and the net profit for her business was $350. Sally is required to file a tax return. True or false? The correct answer is false. According to IRS Pub 17, Table 1-3, self-employed persons with net income less than $400 are not required to file a tax return. Number 4. Jenny is a dependent of her parents. She worked part-time over summer vacation and earned $4,500. Jenny also has investment income of $600. Jenny is required to file a federal tax return. True or false? The correct answer is true. Since Jenny's standard deduction is less than her income, she must file a tax return. Let's take a look at what is involved in figuring out her standard deduction. When you're a dependent of someone, your standard deduction is your earned income plus $300. Jenny's earned income is $4,500 plus $300 is $4,800. Now we compare that to her overall gross income, which is the $4,500 of earned income plus $600 of investment income, and that's $5,100. So her standard deduction is less than her income, and she's required to file a federal tax return. Question 5. Interest and dividend income can be reported on Form 1040-EZ. True or false? This is false. Only interest may be reported on a 1040-EZ. Dividends may not. Dividends need to be reported either on a 1040-A or a 1040. Question 6. You can use Form 1040-A to report which of the following sources of income? A. Interest and dividends. B. Capital gains. C. Unemployment. D. Pension. E. A, C, and D. Or F. All of the above. The correct answer is E. Interest and dividends, unemployment, and pension income can all be reported on the 1040-A. Capital gains may not. They must be reported on the federal Form 1040. Let's move on to page 2. Question 7. Jessica has a balance due on her federal return of $500. She cannot afford to pay her balance due. Jessica decides to file an extension so she can save enough money to pay her balance due by October 15th. Which of the following statements is true? A. Jessica can mail her tax return and her balance due on or before October 15th without being charged a late penalty. B. Jessica will be assessed interest against her balance due beginning on April 15th. C. Jessica is filing an extension. She will not be assessed late filing or late payment penalties. The correct answer is B. Jessica will be assessed interest against her balance due beginning on April 15th. An extension of time to file your federal tax return is not an extension of time to pay. You must go ahead and send what you think you will owe, even though you've extended the time to file the return. If you have a balance due, will be charged interest. Question 8. Sam is a U.S. citizen serving in the Army. He was stationed in Guam on April 15th. Sam's income was $12,000. Which of the following statements is true? A. Sam has until June 15th to file his U.S. tax return and pay any balance due owed on the return. B. Sam must mail his return at least 2 weeks early to avoid a late filing penalty because mail from Guam is really slow. C. Since Sam was stationed in Guam all year, Sam doesn't have to pay any income tax and doesn't need to file. D. Sam has until June 15th to file his U.S. tax return, but he will be assessed interest on any balance due beginning on April 15th. Correct answer for this question is D. Sam does have until June 15th to file his U.S. tax return, but he will be assessed interest on any balance due beginning on April 15th. Please reference IRS Pub 17, page 9, Individuals outside the U.S. Question 9. Bob, age 28, is a resident of the United States. Bob's wife, age 25, and children, ages 3 and 4, are residents of Canada. Bob's wife does not have any income of her own. Bob sends money to Canada to support his wife and children. Bob will file a joint return with his wife. What is the minimum income level at which Bob must file a U.S. return? A. $3,800, B. $9,750, C. $12,500, or D. $19,500. Well, if you look to Pub 17, Table 1-1, which shows the filing requirements for a married individual who does not live with their spouse at the end of the year, you will see that $3,800 is the minimum amount. Question 10. In which of the following situations should you file a return even if you're not required to file? A. You had income tax withheld from your pay. B. You qualify for the earned income credit. C. You qualify for the additional child tax credit. Or D. All of the above. The correct answer for 10 is D. All of the above. In each of these situations, you may have money coming to you from the federal government, and the only way to get it is to file a tax return. So if you had income tax withheld from your pay, but you're not required to file, you will get all that back. Earned income credit is a refundable credit, and you may be able to get money from the earned income credit if you qualify. Same situation with the additional child tax credit. If you qualify for this credit, it's a refundable credit, and you may get money back from the federal government. Question 11. A dependent that had no earned income and received investment income of $850 during the year is required to file a return. True or false? The correct answer is false. The dependent had no earned income and only received investment income of $850. The minimum standard deduction for a dependent is $950. This dependent's investment income of $850 is less than that, so they are not required to file a return. Question 12. A child under age 19 who qualifies as dependent of his parents receives $1,800 of interest income during the year. Since this is his only income, the child will not be required to file a federal return. True or false? The answer is false. A dependent's minimum standard deduction is $950. Question 13. For tax purposes, an individual is considered to be 65 on the day preceding his 65th birthday. True or false? That question answer is true. The IRS has said that anyone will be considered to be 65 on the day preceding their 65th birthday. Question 14. A married filing separate taxpayer who earned $3,800 is required to file a tax return. True or false? The correct answer is A, true. Married filing separate taxpayers have a lower filing requirement than married filing joint taxpayers. Question 15. A taxpayer may file a refund claim up to 3 years after the return was filed or 2 years from the date the tax or a portion of it was paid, whichever is later. True or false? The correct answer is false. A taxpayer may file a refund claim within 3 years after the return was filed or within 2 years from the date the tax or a portion of it was paid. Question 17. You should save your tax records for at least how long? A, 1 year, B, 2 years, C, 3 years, D, 4 years. The correct answer is 3 years. The IRS says that you should keep all of your tax records, your return plus any backup documentation, for at least 3 years. Question 18. The deadline for filing your tax return and paying any tax you owe is extended automatically if you serve in a combat zone. True or false? The correct answer is true. Individuals that are serving in a combat zone. Question 19. You can wait until January to cash a check you receive in December in order to defer taxes until the next year. True or false? The correct answer is B, false. As long as you've received the money in December, you must report it in that tax year, whether you cash it or not. Question 20. Mrs. Smith is 65 and blind. Her husband, Mr. Smith, is age 64. The Smiths will file a joint return. What is their federal standard deduction? A, $11,900, B, $13,050, C, $14,200, or D, $15,300. Well, let's take a look at what their federal standard deductions should be. So first, we have their standard deduction of $5,950 for each Mrs. Smith and Mr. Smith. But in addition to this, Mrs. Smith is 65 and blind, so she will get an additional standard deduction amount for being 65 or older of $1,150, and she'll get an additional amount of $1,150 for being blind. So if you add those together, it totals $14,200. Question 21. Jonathan is single. His parents will claim an exemption for him on their 2012 tax return. He has interest income of $690 and wages of $250. He has no itemized deductions. Jonathan's standard deduction is A, $550, B, $690, C, $940, D, $950. Well, let's take a look. When someone is a dependent of their parents, IRS rules say that your earned income plus $300 up until $5,950 is what your standard deduction would be. So Jonathan has wages of $250. If we add $300 to that, $550. IRS rules also say that $950 is the minimum amount that a dependent has for a standard deduction. Since Jonathan's earned income of $200 plus the $300 is less than the $950, Jonathan's standard deduction is D, $950. Question 23. Archie, who is single, is claimed on his parents' 2012 tax return. He is 17 years old and blind. Archie has dividend income of $2,400 and wages of $600. Archie's federal standard deduction is A, $600, B, $950, C, $2,100, or D, $2,400. So let's take a look at Archie's situation. He's single. He's claimed on his parents' return as a dependent. So we know right away the minimum that his standard deduction is going to be is $950, and the maximum is going to be $5,950. But we need to take a look at what wages plus $300 are. And in this case, Archie's wages are $600. If you add the $300 to that, you only come up with $900. We already know the minimum needs to be $950. But Archie is also blind. And since Archie is blind, he gets to take the additional standard deduction amount on his return. His parents do not claim that. So when you are single and blind, the additional amount of federal standard deduction you get is $1,450. So if we take the $950 plus the $1,450, we end up having Archie's federal standard deduction is D, $2,400. Question 24. If you want to file your federal tax return electronically, A, you must use a tax preparer. You can't do it yourself. B, you must sign the return electronically with a PIN number. C, it must not be a balance due return. D, you must agree to have your refund deposited directly in your bank account. The correct answer is B. You must sign the return electronically with a PIN number. Question 25. If you are paid to prepare a federal tax return for an individual, you A, must have a tax preparer identification number, also called a PTIN, from the IRS to put on returns. B, may use your Social Security number to identify yourself as preparer on the return. Or C, are not required to fill out the preparer information on the return. It is voluntary. The correct answer is A. You must have a tax preparer identification number, a PTIN, from the IRS to put on return. All paid preparers must have this PTIN number, and you can get it from the IRS. They use this number to identify the person that's preparing the return. Answer B is not correct. Your Social Security number used to be able to be used, but several years ago the IRS went to only allowing PTIN numbers. And C, you are required to fill out all the preparer information on the return. The IRS wants to know who's preparing the return if it is not the taxpayer themselves. Question 26. If you do not file your federal tax return by the due date, including extensions, the penalty is A, usually not more than 25% of the tax not paid by the due date, B, usually 5% per month or part of a month of the tax not timely paid, or C, higher if the return is more than 60 days late, D, all of the above. The correct answer is D, all of the above. Quiz review for Session 1 has now ended. We will proceed to Session 2's lecture video. Welcome to Personal Exemptions and Dependence.
We're looking now at personal exemptions and dependents, and firstly we're just going to talk about what the concept of an exemption is. An exemption is a tax deduction that reduces your taxable income. For 2012, you can generally claim a deduction of $3,800 for each exemption on your tax return. Form 1040 provides for two different types of exemptions, and you can see that the top of the 1040 form, which I've cut out here and placed on the screen in front of you, is divided into lines 6A and 6B, where you enter an exemption for yourself, and if you're married, an exemption for your spouse, usually when you're filing a joint return. And then it separates out on line 6C a space to enter the name, Social Security number, relationship of a qualifying relative or a qualifying child who is your dependent. So essentially, the two different types of exemptions that we're going to talk about today are the personal spousal exemption as one category and the dependency exemption as a separate category. There are limits on exemptions that were in play prior to 2010, and they will be in play again for 2013 and future years. Prior to 2010, your exemption deduction of $3,800, well, for 2012 it's $3,800, in earlier years it was a lesser number. Your personal exemption deduction could be reduced or eliminated if your income rose above a certain level based on your filing status. This reduction or phase out of the exemption deduction was repealed for tax years 2010 through 2012. But it will return for 2013. The Taxpayer Relief Act of 2012 provides for a return of the phase-out on the exemption deduction for 2013 and future years. And what will happen is that if your income exceeds the amounts shown here for your filing status, your exemption deduction will actually begin to phase out and can actually be eliminated completely in some cases. Let's talk about the different types of exemptions and who can claim them under the personal category. Firstly, if you are single, you can claim your own personal exemption if you are not the dependent of somebody else. If another taxpayer is entitled to claim you as a dependent, you cannot take an exemption for yourself, even if the other taxpayer does not actually claim you as a dependent. If you are married, you generally allowed one exemption for yourself, and if you are married filing a joint return, one exemption for your spouse. You may claim an exemption for your spouse on a married filing separate return only if your spouse had no gross income and was not the dependent of another filer. Now, one of the things I wanted to point out about this $3,800, and this may be kind of a silly way of doing it, but why don't we throw a little bit of humor in here today? I've used this explanation for years, but today I'm going to get visual about it. Here's $3,800, and I'm going to stick it on my forehead. I don't know if you can read it, but it does say $3,800 right there. All right? So every person in the country is entitled to a $3,800 deduction on their return. See if the camera's getting it finally. $3,800, there you see it. So there's my $3,800 sticky note. And I can take this sticky note and put it on my forehead and say, I'm worth $3,800 as a tax exemption. My $3,800 can be claimed by me if I qualify to claim it. But if I'm the dependent of someone else, I don't get my $3,800, they get my $3,800. And by the same token, if I have children that I'm caring for that are my dependents, I'm going to get a $3,800 exemption for each of my dependents. And if I claim their exemption, they cannot also claim it. So the $3,800 rule is that each person living and breathing in the United States is entitled to that $3,800 exemption, but only once. And rules dictate whether or not they're allowed to claim their own $3,800 or whether that $3,800 will be claimed by someone else. When we look at a single filer, if you are filing single, you are allowed your exemption, but only if you are not the dependent of someone else. Because if you are the dependent of someone else, then they can claim that exemption instead of you. And in fact, even if they choose not to claim your exemption, it doesn't mean you are allowed to. You're only allowed to claim your own exemption if you are not the dependent of someone else. For a married person, you can claim your exemption. If you're filing a joint return, you can claim your spouse's exemption. And in certain situations, you can claim your spouse's exemption even if you're filing separately, so long as your spouse has no income for the year and is not the dependent of someone else. Married, that was what we just talked about. Finally, we're moving on to death. If your spouse died during the year, you generally can claim your spouse's exemption under the same rules that apply to married people. If you remarry during the year, you cannot claim an exemption for your deceased spouse. However, if you have no income, your exemption can be claimed by both your new spouse and your deceased spouse on each of their married filing separate returns. So I just took that $3,800 and said you can only claim it once. There's this rare situation in the tax code where a personal exemption of a spouse can be claimed twice, but it's only in that very rare situation where the spouse was married. Let's just say Jane is married to John. John dies, and before the end of the year, Jane marries Charles. Jane has no income. Both John and Charles, if they filed separately, could claim Jane's exemption. But if Charles and Jane file a joint return for the year, then John would not be able to claim Jane's exemption. And finally, divorced or separated spouse. If you obtained a final decree of divorce or separation by the end of the year, you cannot claim your former spouse's exemption. This rule applies if you provided all of your former spouse's support for the year. So that's the nutshell on personal exemptions. Now we're going to move on to dependency. Dependency is a more complicated subject to understand. Determining who qualifies as your dependent should be simple. However, it is often confusing. Correctly determining whom you can and whom you cannot claim as a dependent is one of the most important areas of the tax return. There is one test for yourself and tests for each type of dependent. Qualifying child, qualifying relative being the two different types of dependent. All of the tests must be met or you cannot claim an exemption for that person. Firstly, there is the dependency test for yourself. You cannot claim any dependents if you or your spouse, if filing jointly, could be claimed as a dependent by another taxpayer. Dependency test for a qualifying child. To claim an exemption for a qualifying child, you must meet all 7 of the following tests. And of course, the first test that you have to pass is that you can't be anyone else's dependent. You cannot have a dependent if you are a dependent. So let's assume you are not the dependent of someone else. Then you move on to these 7 tests. The first test, when you're looking at the individual that you think is your qualifying child, is the joint return test. That qualifying child cannot be filing a joint return. Then we have the U.S. citizen or residence test, the relationship test, the age test, the residency test, the support test, and finally a special test in a situation where you have a qualifying child of more than one person. So we're going to take each of these tests in turn, beginning with the joint return test. You generally cannot claim an exemption for your dependent if he or she files a joint return. However, if your dependent files a joint return merely to claim a refund and no tax liability would exist for either spouse on married filing separate returns, then you can still claim your dependent's exemption. Citizen or U.S. resident test. For this test, for some part of the calendar year, the person you are claiming as a dependent must have been a U.S. citizen or a resident of the United States or a resident of Canada or Mexico. Under the relationship test, to meet this test, the person you wish to claim as a qualifying child must be your child, grandchild, great-grandchild, etc., or a stepchild. But please note that a stepchild is a child of your spouse. A child of a boyfriend or a girlfriend is not your stepchild. And I make a point of putting that in there because when I have clients come into me, particularly new clients, and they're presenting to me the people that they're going to be claiming as dependents, I get right into these dependency questions, these dependency issues. The IRS says that when you are determining the eligibility of a person as a dependent, that you have a due diligence requirement as a tax preparer to ask the questions necessary to determine whether or not a person is actually a dependent of your filer. And if there's anything that comes up that could indicate that perhaps this person doesn't qualify as a dependent, you need to ask probing questions necessary to establish that a dependency situation does in fact exist. So under the relationship test for qualifying child, the rule is that a stepchild qualifies, but a stepchild is a son or daughter of your husband or wife. So let's look at an example that I've really had. I have a client come in and sit down in front of me and she says, "Hi, my name is Jane." And I go, "Well, hi, Jane." And Jane says, "Yes, I'm filing this year and I've got my 2 dependents. One of them is my stepson." And the first thing I think is, okay, Jane, where's your husband? You have a stepson, you're filing return, where's your husband? Because typically the stepson means that you are married to someone. And so then the answer will be, well, we've never been married. I just call him my stepson because we live together like we're husband and wife, but we're not really married. Well, that immediately tells me that the person she's calling her stepson is not in fact her stepson. In fact, he's not related to her in any way. Under the dependency test, we would basically say that person possibly is a dependent under the qualifying relative tests, but under the qualifying child test definitely flunks this test, the relationship test. We also look at eligible foster child. IRS says that an eligible foster child meets the relationship test if that child was placed with you by an authorized agency. If the child was placed with the filer by an authorized agency, then the child is considered to be the same as a child. And finally, brother, sister, half-brother, half-sister, stepbrother, stepsister, or descendant of any of them, such as a niece or nephew, is also considered to meet the relationship test for purposes of qualifying child. The next test under the qualifying child rules is the age test. To meet this test, a child must be under age 19 at the end of the year and younger than you or your spouse if filing jointly, or must have been a full-time student under the age of 24 at the end of the year and younger than you or your spouse if filing jointly, or permanently and totally disabled at any time during the year regardless of their age. And here's an example of what we mean by your dependent must be younger than you or your spouse if filing jointly. Your 23-year-old brother, who is a full-time student and unmarried, lives with you and your spouse. He is not disabled. Both you and your spouse are 21 years old and you file a joint return. Your brother is not your qualifying child because he is not younger than you or your spouse. Now, he could be a qualifying relative, but right now we're on the test for qualifying child, and your brother who is older than you can never be your qualifying child. Residency test. To meet this test, a child must have lived with you for more than half the year. However, there are exceptions for temporary absences due to illness, education, business, vacation, or military service, also due to death or birth of the child during the year, kidnapped child if all of the following are true. The child is presumed by law enforcement to have been kidnapped by someone who is not a member of your family or the child's family. In the year the kidnapping occurred, the child lived with you for more than half of the part of the year before the date of the kidnapping. There is no determination in a prior year that the child is dead, and the child would still be under age 19. So if you meet all four of these tests, a kidnapped child can still be claimed as your qualifying child. Number 4 for residency test. Children of divorced or separated parents. This rule also applies to parents who were never married, by the way. A child will be treated as the qualifying child of the non-custodial parent if all of the following rules apply. Number 1, the parents are divorced or legally separated under a decree of divorce or separate maintenance, separated under a written separation agreement, or lived apart at all times during the last 6 months of the year. The child received over half of his or her support for the year from the parents. The child is in the custody of one or both parents for more than half of the year, and a decree or written agreement that applies to 2012 provides that the non-custodial parent can claim the child as a dependent, or the custodial parent signs a written declaration such as Form 8332, or a similar statement that he or she will not claim that child as a dependent for the year. So typically, there is a residency requirement for a qualifying child, and the residency requirement demands that that child lives with you. There is an exception for residency requirement if the child is kidnapped, and an exception if the child is being claimed by the non-custodial parent. Support test. To meet this test, the child cannot have provided more than half of his or her own support for the year. To see what is or is not support, refer to IRS Publication 17, page 33, Support Test to be a qualifying relative. Note that if a child is supported by state welfare, housing, or other benefits, such support is considered to be provided by the qualifying relative, but is not considered to be support provided by a qualifying child. And then we have some special tests for qualifying child of more than one person. If you and another person have the same qualifying child, you and the other person can agree between you which of you will be entitled to claim that child as a qualifying child. Whoever amongst you ends up claiming that child will then be eligible for all of the benefits associated with that child, including the exemption for the child tax credit, the head of household filing status, the credit for child and dependent care expenses, the exclusion from income for dependent care benefits, and the earned income credit. The other person who gives up that dependency exemption cannot claim any of these benefits on this particular qualifying child. In other words, you and the other person cannot agree to divide the benefits between you. Now, there's only one exception to this general division rule, and that is in the case of divorced or separated parents. If the child's exemption is being released by the custodial parent to the non-custodial parent, the custodial parent will still be entitled to head of household filing status, the credit for child and dependent care expenses, and the earned income credit. They will release only the dependency exemption and the child tax credit, but not these other benefits. However, if the child is a qualifying child of people who are living together and members of the same household, married or not, releasing that exemption between those individuals means that whoever claims the child gets all of the benefits associated with that child, and the other individual gets none of the benefits associated with that child. Now, if you and the other person who qualify to claim the same child cannot agree on who will claim the child, the IRS has tiebreaker rules that you apply to determine which of you, in fact, will be entitled to claim that child. So if more than one person qualifies to claim a child on a tax return, but only one of those persons is the child's parent, then the child will be treated as the qualifying child of the parent. If two of the persons are parents of the child and they do not file a joint return together, the child will automatically go to the parent with whom the child lived the longer period of time during the year. If both of the persons are parents of the child and they do not file a joint return together and the child lived with each of the parents for the same amount of time during the year, then the child would go to the parent who has the highest adjusted gross income. Now, if none of the persons are the child's parent, then it will go to the person who has the highest adjusted gross income. But if either parent can claim that child as a dependent and chooses not to, then it is only possible to release the dependency of that child to a person who is not a parent if that person has income that is higher than the highest AGI of the parents. Password number 1 is pronghorn. P-R-O-N-G-H-O-R-N. Pronghorn. Now, that's a lot to absorb, and so yesterday I actually was thinking maybe I could give you an illustration for this particular tiebreaker rule. I'm going to talk a little bit more about these tiebreaker rules, and then we'll move on to the definition of a qualifying relative and see how that compares with a qualifying child. So tax benefit allocations for a child when the parents are living together. Wendy and Casper are an unmarried couple who have a son named Richie. Wendy, Casper, and Richie lived together as members of the same household all year. Wendy's wages were $20,000, and Casper's wages totaled $30,000 for the year. If Wendy and Casper agree, Wendy can claim all of the benefits associated with Richie except one of the following. And we have EIC, dependency, child tax credit, child independent care credit, and head of household. So those are all of the benefits associated with that child that typically could be claimed by Casper or Wendy. If Casper agrees to let Wendy claim Richie, Wendy clearly probably will not qualify for the head of household filing status. Her income is significantly lower than Casper's. It's technically possible that she could have paid more than half the cost of keeping up the household, but harder to establish that when her income is significantly less than Casper's. So Casper, if he releases the exemption to Wendy, will give up any entitlement he has to earned income credit. He will lose the dependency exemption. He will lose the child tax credit. He will lose the child independent care credit, and he will lose head of household filing status. Wendy would be entitled to all of these benefits, but of course to claim head of household she would have to have paid more than half the cost of keeping up the household, and it's unlikely that she can show that. Now, if Casper decides to claim Richie's dependency exemption, he's entitled to all of the benefits that we see here. However, odds are his earned income credit will be pretty tiny because, of course, earned income credit works on a bell-shaped curve, and as your income rises in that bell-shaped curve, you get more and more EIC, and then when you reach a certain point, as your income continues to rise, you lose that earned income credit entitlement altogether. So a single person with $30,000 of income is going to be entitled to significantly less earned income credit than a single person earning $20,000. Okay, so let's look at another situation where the tiebreaker rules are in effect. Tax benefit allocations with a person who is not the parent of a child. Under the tiebreaker rules, if a child qualifies as a qualifying child of more than one person, and one of those persons is not that child's parent, but the other one is a parent, the parent can release the child's exemption to the other person, but only if that person's income is higher than the highest income of either parent who is otherwise entitled to claim that child. And here's an example. Veronica is the single parent of daughter Becky. Veronica and Becky live with Veronica's mother, Ardith. Ardith's income is $40,000, and Veronica's income is $20,000. Because Artist's income is higher than Veronica, Veronica can choose to allow Artist to claim Becky as a dependent. If Artist claims Becky's dependency exemption, she will be entitled to all of the benefits associated with Becky's dependency exemption, including EIC, dependency, child tax credit, child and dependent care benefits, and the head of household filing status. But if Veronica decides to claim Becky's dependency exemption, she's not going to be entitled to one of these benefits, and that benefit is head of household filing status. Obviously, with income half that of her mother, living in her mother's home, she's not going to qualify for that status. And clearly, Becky can be claimed as a dependent of Artist, but Artist earns too much money probably to claim earned income credit. So when I have a situation like either of those described in either of these tiebreaker situations, Casper and Wendy or Artist and Veronica, if the filers are amenable to it, I'll actually run the numbers both ways for each of them to show them how their household might come out the best. If they can agree to give the benefit to the person who will benefit the most, then I can actually show them how much they will save by doing it that way. So now I am back in the manual. And in the manual, you will see that I have a table. It's a flow chart. This flow chart is not to be found anywhere in Pub 17 today. However, 2004 and earlier years, the IRS did include a table like this one in Pub 17. But in 2005, the IRS did away with this dependency flow chart and replaced it with a separate kind of table. And I always liked the table, especially when it comes to teaching a class. I like how the table works, or this flow chart works. And so I've made a point every year of maintaining a flow chart of my own just to help my students better understand the rules and how to apply them for dependency. So we're looking at a flow chart for qualifying child. And the first test we look at when we're trying to determine whether or not we can claim a qualifying child is the dependent taxpayer test. Are you the dependent of another person? If the answer is yes, you're done. You don't have a qualifying child. If the answer is no, you move on to the joint return test. Did the child file a joint return for the year unless that return was filed only as a claim for refund? If the answer is no, no joint return was filed, you move on to the U.S. resident or citizen test. Was the child a U.S. citizen or resident, or was that child a resident of Canada or Mexico for any part of the year? If the answer is yes, you pass that test and move on to the relationship test. Under the relationship test, was the child your child, grandchild, stepchild, brother, sister, niece, nephew, or descendant thereof, or your eligible foster child? If the answer is yes, you move on to the age test, but if the answer is no, you're done. You don't have a qualifying child. It's possible you still have a qualifying relative, but you don't have a qualifying child, and that's what we're talking about right now. So if you do meet the relationship test, or your child does meet that relationship test, we move on to the age test. Under the age test, the child must be either under age 19 and younger than you, or your spouse if filing jointly, or a full-time student who is under the age of 24 and younger than you or your spouse, or any age at all if the child is permanently and totally disabled on the last day of the year. If you meet the age test, then you move on to the residency test. Did the child live with you for more than half the year? If the answer is yes, you move on to the support test. Did the child provide more than half of his or her own support for the year? The answer in this case must be no. If the child provided more than half of his or her own support, you don't get to claim them. But if they did not provide more than half of his or her own support, then you move on. And you'll notice it isn't the case that you have to provide more than half of your qualifying child support, only that your child cannot have provided more than half of his or her own support. If you can show that the child did not provide more than half the support, you move on to the next test, which is the special test of a qualifying child of more than one person. Is your child the qualifying child of another person? If the answer is no, you're done. You have a qualifying child. If the answer is yes, you move on to the first of the tiebreaker rules. Does the other person agree to allow you to claim that exemption? If the answer is yes, I'd get that approval in writing on Form 8332 or a similar statement, and then go ahead and claim that child. But if the answer is no, do you win under the tiebreaker rules? If you win under the tiebreaker rules, regardless of what that other person says, you're still entitled to claim that child. For dependents of divorced or separated parents, just as a reminder, beginning with 2009 tax returns, a custodial parent is the parent with whom the child spends the greatest number of nights during the year. In the instance where the child spends an equal number of nights with each parent, the custodial parent will be the one with the highest AGI. A non-custodial parent claiming an exemption for a child can no longer attach pages from a divorce decree or separation agreement instead of Form 8332 if that decree or agreement went into effect after 2008. For divorce or separation agreements that went into effect after 2008, the following provisions apply to a non-custodial parent who claims an exemption for a child. The non-custodial parent must attach Form 8332 or a similar statement signed by the custodial parent. The signed statement must have the sole purpose of releasing a claim to that child's exemption. The non-custodial parent must attach the required information even if it was filed with a return in an earlier year. There's also a rule in play for revocation of a release to a claim for a child's exemption. And for tax years beginning after July 2nd, 2008, the 2009 calendar year for most taxpayers, new rules apply which allow the custodial parent to revoke a release for a claim to an exemption that was previously released to the non-custodial parent by filing Form 8332 and checking the revocation portion of the page. The revocation is effective no earlier than the tax year following the year in which the custodial parent provides or makes reasonable efforts to provide the non-custodial parent with a written notice of the revocation. Therefore, if the non-custodial parent provides a notice of revocation to the non-custodial parent in 2012, the earliest tax year that the revocation can be effective is tax year 2013. So let's just suppose that we have Samantha and John. And Samantha has released her child's exemption to the father of the child, John, by signing Form 8332 and checking the all future years box. Samantha has a change of heart and says, no, I want to revoke that all future years. Samantha needs to make that revocation in the year before the year it's to become effective. She can't just get to the table at filing season time and say, well, gee, I'm mad at John. I'm not going to let him claim the child. I want to take him back. It has to be done well planned and in advance. How do you revoke the election? Well, you do so in Part 3 of Form 8332. If you are the custodial parent who released and then revoked the release to the exemption for your child, you must attach a copy of the revocation to your return for each year you claim the child as a dependent as a result of the revocation. Here is Form 8332. In Part 1, you enter, the filer who is giving up the exemption for the child says, give up the exemption for the child, and you enter the child's name, and then you enter the year to which that release applies. The parent giving up the exemption signs the form, and the form is then filed with the IRS as an attachment to Form 8453, if they're e-filing, by the parent who is getting the exemption, the non-custodial parent now claiming that child. Release of claim to exemption for future years. A parent can agree to release the exemption for a child for future years, and you name the child and then the tax years in effect, and then sign. And then a revocation of a release to exemption for future years. I revoke the release of exemption. You name the child and the years to which the revocation has been rescinded. Password number 2 is ROSE. R-O-S-E. ROSE. The dependency tests for qualifying relative are what we're going to talk about next. And we've just been spending quite a bit of time talking about the qualifying child test. Now we're going to talk about qualifying relative. To claim an exemption for a qualifying relative, you have to meet all 6 of the following tests. There's the joint return test, the member of household or relationship test, the citizen or resident test, the gross income test, the support test, and the not a qualifying child test. You can look at these. You could put an acronym using the first letter of each test Joe must come get supper now. If you're studying for an exam, sometimes these tests can get to be a little bit overwhelming, and if you memorize the sentence, Joe must come get supper now, and what each word of this sentence correlates to, that could help you remember the tests if you're trying to apply them in a testing situation. Firstly, let's look at the joint return tests. It's similar to what we saw under qualifying child, and that is you cannot claim an exemption for your dependent if he or she files a joint return. However, if your dependent files a joint return merely to claim a refund and no tax liability would exist for either spouse on their separate returns, you can still claim your dependent's exemption. Citizen or resident test. For some part of the calendar year, the person must be a U.S. citizen or a resident of Canada or Mexico. Member of household or relationship test. To meet this test, the person must live with you for the entire year as a member of your household, or that person must be related to you in one of the following ways. Now, this isn't member of household and related to you. It's member of household or related to you. If the person is not related to you, they have to live with you the entire year. But if they are related to you, they don't have to live with you at all to be your dependent. So who does not have to live with you to be your dependent? Well, it's a person who's related to you, and any of the following relationships qualify: child, grandchild, great-grandchild, stepchild. But remember, a stepchild is a child of your spouse. A child of your boyfriend or girlfriend is not your stepchild. Eligible foster child, but only if that child was placed with you by an authorized agency. Brother, sister, half-brother, half-sister, stepbrother, or stepsister. A parent, grandparent, or other direct ancestor, but never a foster parent. Stepmother or stepfather, brother or sister of your parent, including an aunt or an uncle. Son or daughter of a brother or sister, such as a niece or nephew. A father-in-law, mother-in-law, daughter-in-law, son-in-law, brother-in-law, sister-in-law. All of these relationships satisfy the member of household or relationship test. But if the person you wish to claim as dependent is not related to you in one of these ways, then they must have lived with you as a member of your household for the entire year. Some special notes for you about relationship. Any relationship established by marriage is not ended in death or divorce. So in other words, your in-laws will always be your in-laws. Before legal adoption, a child is considered to be your child once that child is placed with you by an authorized agency. An eligible foster child meets the relationship test and does not need to live with you to qualify as your dependent. Your cousin does not meet the relationship test and must live with you as a member of your household for the entire year. A person who died during the year but was a member of your household until death will meet the member of household test. In this situation, the decedent is considered to have been a member of your household for the entire year. So even if a baby is born and only lives for an hour, it was born alive and will be considered a dependent for the entire year and will be considered to have lived with you for the entire year. And similarly, if you have a relative that you're supporting and that relative dies partway through the year, that person will be considered to have been your dependent for the entire year. Finally, a child who was born during the year will meet the member of household test if she lives with you for the remainder of the year. By the way, required hospital stay is considered to be time spent in your household if the child would otherwise have been a member of your household. A child born during the year is considered to have lived with you for the entire year. Gross income test. This is a little bit different than the support test that we saw for qualifying child. Qualifying child has no income rule at all, but they do have a support rule in that the qualifying child cannot have paid more than half of his or her own support. When we get over to qualifying relative, we have a gross income test. This is a unique test that applies only to qualifying relatives. You generally cannot claim an exemption for your dependent if he or she had gross income of $3,800 or more for 2012. Gross income generally includes all sources of income, whether or not they are used for support. However, gross income does not include tax-exempt income such as certain Social Security payments, payments received by a permanently and totally disabled person for services he or she performed at certain sheltered workshops, or scholarships received by a degree candidate that are used for tuition fees, supplies, books, and equipment required for particular courses. Support test. You must provide more than half of a person's total support for the year to meet the support test. It does not matter if the money you provide for support comes from savings or earnings or from money that you borrow, so long as the money is spent on support during the year. Included in total support are things like tax-exempt income, such as certain Social Security benefits and military housing allowances that are used for a person's support. Also, foster care payments that you receive from a state or federal agency for the care of an individual are considered to be amounts provided by the state and not by you. If you are in the trade or business of providing foster care, your unreimbursed expenses are not considered to be support provided by you. Support provided by the state, including food stamps, housing, etc., must be considered when factoring support unless it can be shown that the benefits were not used for that purpose. Also, a person's own funds that are spent on support have to be factored into support. A child's wages that are spent on his or her own support are factored into support, and the fair market value of free rent is also factored into support. I see a question here. Certain Social Security benefits or certain Social Security payments such as SSI, are they part of support? It depends. SSI is typically going to be issued in the name of an individual, and if that money is spent on their support, then it is factored into that person's support, regardless of who the SSI was paid to. So if I have a child who's receiving SSI, and that SSI that my child is receiving is $10,000 for the year, that money is going to be support provided for that child. If it's a qualifying child, it's not going to be considered to be support provided by the child, but it's also not going to be considered support provided by me. If I'm looking at the qualifying relative test, that support is not going to be considered provided by me, but it is going to be considered support for that person, and I must pay more than that if I'm going to pass that support test. We're coming up to a support worksheet in just a minute. I'll show you how it works. Now, some of the things that you do not include in total support are things like federal, state, and local income taxes paid by persons from their own income. So if I earn $40,000 for the year, but I have to pay out $10,000 in tax, it means that I only have $30,000 to contribute to support. If I have a person who is a dependent, and that dependent earned $10,000 for the year, then I'm looking at how much money that person had to pay in tax, and any money they paid in tax is not going to be considered part of their support. Now, of course, if they have $10,000 of income, they couldn't be my qualifying relative now, could they? Because they'd fail the gross income test. But if they meet other tests, they might still be a qualifying child. Social Security and Medicare taxes paid by persons from their own fund are not factored into support. Life insurance premiums are not factored into support, nor are funeral expenses. Scholarships received by your child, if the child is a full-time student, are not factored into support, and survivors and dependents' educational assistance payments used for the support of a child who receives them are also not considered to be factored into total support. Determining total support. To figure if you provided more than half of a person's support, the IRS provides a worksheet for determining support. The worksheet accounts for all of the following: all forms of money and property that might be used for the support of an individual, the division of support when the support is provided by more than one person, and when the support is provided by more than one person, including the dependent, it accounts for how much was provided by you. And here is the table. It comes out of IRS Publication 17. You can find it on page 30. You can see the first thing it asks for is funds belonging to the person that you supported. It then asks how much of those funds was spent on that person's support. A dependent could have $100,000 in the bank and spend none of it on their support. If they didn't spend it on support, it doesn't count for support. Then we look at expenses for the entire household, where the person you supported lived. When you have expenses being paid for an entire household, only a portion of the expenses can be applied to the support of a particular individual, and so the worksheet walks you through that. Then we have expenses for the person that you supported directly. These are direct expenses for that person's support, such as the cost of clothing the person, educating the person, medical and dental expenses, travel and recreation, and any other expenses specifically paid for that person. And did the person provide more than half of his or her own support? And finally, did you provide more than half the support? If the person provided more than half of his or her own support, they're not a qualifying relative or a qualifying child. But if you provided more than half of their support, it could be that you have either a qualifying child or a qualifying child in that you have passed the support test. Now, I did create a separate qualifying relative flowchart, and that we have here. You can see it's a little bit different than the qualifying child flowchart. In fact, after class is over, you could even line the two flowcharts up beside each other and compare them and see where differences come into play. Under the qualifying relative flowchart, you still have to pass that dependent taxpayer test. Are you the dependent of another person? Because if you are, you cannot have a dependent. But if you are not the dependent of someone else, then we move on to the joint return test. Did the person for whom you wish to claim an exemption file a joint return with someone else? If the answer is no, you move on to the U.S. citizen or resident test. Was the person you wish to claim as a dependent a U.S. citizen or a resident, or was that person a resident of Canada or Mexico during the year? If the answer is yes, then was the person you wish to claim as a qualifying relative the qualifying child of you or anyone else? If they meet the qualifying child tests of you or anyone else, they cannot be your qualifying relative. They might be your qualifying child, but they couldn't be your qualifying relative. And if the person you wish to claim as a qualifying relative is in fact the qualifying child of someone else, but not your qualifying child, you're out. You don't even get to have an option. The next test is member of household or relationship test. Was this person either a member of your household for the entire year or related to you? If the answer is yes, then you move on to the gross income test. Did the person have gross income of $3,800 or more for the year? The answer must be no. If it is, then you have the support test. Did you provide more than half that person's support for the year? If the answer is yes, then you have a qualifying relative. And just an important reminder here, a dependent who is your qualifying child or the qualifying child of another filer can never be your qualifying relative. Now, the very last thing to throw at you before we finish today's class is that not too common situation where you have a person who falls under a multiple support agreement. Multiple support agreement comes where you have a person who meets every single test here except the support test. You pass every test. In other words, you can show that the person you want to claim as a dependent is not filing a joint return, that they are a U.S. citizen or resident, that they're not a qualifying child, that they were a member of your household or related to you, that they passed the gross income test, but you get down to this final support test and you just cannot show that you paid more than half. But you can show that you and another person who meet all of the tests could, between you, have provided more than half. And when that happens, you have a multiple support agreement. A multiple support agreement allows you to claim a deduction for a person who was supported more than 50% by 2 or more people, none of whom provided more than half of the support individually. To qualify to claim a dependent under the multiple support agreement, all of the following must be true. Any person who meets all of the other tests to claim an exemption for the dependent and provided more than 10% of the support is eligible to claim the dependency. However, you must agree who will actually claim the exemption on his or her return. Those persons who do qualify but are not claiming the dependency exemption must agree to relinquish their entitlement to the exemption by signing an agreement not to claim the exemption for the year. Form 2120 serves as that agreement. The person who claims the exemption must keep Form 2120 or a similar statement signed and in his or her records for the required minimum amount of time. And finally, the person who claims the exemption must also identify each of the others who were eligible to claim the exemption but agreed not to on Form 2120 and then attach 2120 to his or her return. To give you an example of where a multiple support agreement might apply, Alice is a dependent who contributed 20% of the cost of her support. So it cost a certain amount of money to support her, and she paid 20% of her support. The rest of her support was provided by her 3 sons. We have a son named Jerry who provided 9% of her support, a son named Samuel who provided 25% of her support, and a son named Chris who provided 46% of her support. Now, Jerry, Samuel, and Chris between themselves provided 80% of her support, but none of those individuals provided more than half. So we're in a situation that we have a multiple support agreement. And between Jerry, Samuel, and Chris, Jerry provided 9%, Samuel provided 25%, and Chris provided 46%. So if we're looking at these rules here, we have two individuals, Samuel and Chris, who provided more than 10%. Those are the only two of the three sons who are eligible to claim Alice's dependency exemption. And whichever of them agrees to release the exemption signs Form 2120. And let's just say that Samuel agrees to release Alice's exemption to his brother Chris, because Chris provided 46%. Well, if that's the case, Samuel would sign Form 2120, and Chris would attach Form 2120 to his return. I do see a question here. We have several low-income, I assume clients, that want to claim qualifying child but have low income. Is there a general number to start with, for example, $3,800? Well, what you're looking at with qualifying child is you don't need to show you supported the child at all, and you also, with a qualifying child, do not need to worry about the child's income unless that child spent their income on their own support. So you literally could have a client who only earned $3,800 for the year, and they're receiving all of the rest of the support that they use to live on for themselves and their child through gifts or through welfare or state benefits such as Section 8 housing, food stamps, and so forth. And when you're dealing with a qualifying child, none of the support provided by those outside agencies is considered to be support provided by the child. And therefore, you could have a qualifying child even though you cannot show that you provided support for that child. So for qualifying child, there is no support test in terms of you providing support. The only support test that applies to a qualifying child is if that child provided more than half of his or her own support. And if you're trying to figure that out, that's why they have the worksheet. So the very final page of the manual, we can say we're essentially done with this course except for one last page. Remember that your dependent must have a Social Security number, and if they don't have a Social Security number, you typically need to apply for an ITIN or an ATIN. The only exception to that is if the child was born and then died during the year. If you have a child that was born and died so quickly that they couldn't get a Social Security number, the IRS wants you to attach the birth certificate to the return instead. And where you would normally enter the Social Security number, you write died under that child's exemption. On page 1 of the return, line 6C, where you enter your dependent and the dependent Social Security number, you would enter died there. Also, the child tax credit. Most qualifying children will qualify you for the child tax credit. For 2012, the credit is $1,000 for each qualifying child, and of course the child must be under age 17 and meet various other tests. Not all qualifying children qualify for the child tax credit. The child tax credit is tied to the dependency exemption, however, and if you give up or release the child's dependency exemption, you are also going to release the child tax credit with that. For purposes of the child tax credit, a qualifying child is a child who was your son, daughter, stepchild, foster child, brother, sister, stepbrother, stepsister, or descendant of any of them, was under age 17 on the last day of the year, did not provide more than half of his or her own support, lived with you for more than half of 2012, is claimed as a dependent on your return, and was a U.S. citizen, U.S. national, or a U.S. resident alien. Please note that the rule for dependency that allows that person to live in Canada or Mexico does not apply for the child tax credit. That child must live with you inside of the United States. Qualifying relative, is $3,800 a good number to start with? Well, $3,800 is an important figure when you're talking qualifying relative, because if your qualifying relative earned more than $3,800, they're not your dependent. Right here, gross income test. Your qualifying relative, did they earn $3,800 or more for the year? If they did, they're not your dependent. And I did want to show you something else. Let me pull up Pub 17 again real quick. Pub 17 actually has a table that you use for applying the qualifying relative and qualifying child tests. And you might find that it helps clarify things for you. I personally prefer the flowcharts, possibly just because that's what I grew up with. But inside Pub 17, you actually have this table here, Table 3.1. It appears on page 26 of Pub 17. And this particular table is the table that the IRS asks you to use when you're trying to differentiate between the rules for qualifying relative and the rules for qualifying child. And if you start up at the top, it says, to claim a dependent at all, you have to meet these first 4 bullet points. The first one being you cannot claim any dependents if you or your spouse of filing jointly can be claimed as a dependent by someone else. You cannot claim a married person who files a joint return as a dependent unless that joint return is filed only to claim a refund of withheld income tax or estimated tax paid. You cannot claim a person as a dependent unless that person is a U.S. citizen, U.S. resident alien, U.S. national, or a resident of Canada or Mexico. You cannot claim a person as a dependent unless that person is your qualifying child or is your qualifying relative, and then they look at the test for being a qualifying child versus the test for being a qualifying relative. To be a qualifying child, it has to be your child or your stepchild, foster child, etc. The child must be under age 19 or under age 24 and a full-time student or any age and disabled. The child must have lived with you for more than half the year. The child must not have provided more than half of his or her own support, and the child is not filing a joint return for the year unless that return is filed only to get a refund of income tax withheld. Versus the test for qualifying relative, the person cannot be your qualifying child or the qualifying child of anyone else. The person must be related to you in one of the ways listed under relatives who do not live with you or do not have to live with you, or the person must be a member of your household for the entire year. The person's income must be less than $3,800, and you must have provided more than half of that person's total support. What if the person claiming earned less? Well, if you are a person trying to claim a dependent and you earned less than $3,800, you're going to have to show that you provided more than half of their support. It's possible. Maybe you had zero income for the year, but you have $1 million in the bank. You could have a dependent, and you could show that you're not the dependent of anyone else. So it's possible to be able to claim dependence even though you have very low income. Or it's possible to show that you provided vast amounts of money towards the support of a person even though your income is low, because you don't have to have income to support people. You can have other resources such as money that you borrow or money that you have in savings or even property that you sell and then use for support. Password number 3 is whitetail, W-H-I-T-E-T-A-I-L, whitetail.
Okay, so you should have paused the video and completed the classwork assignment for session 2. And now we're back to do the classwork review. So question 1. So in what circumstances would Form 2120 Multiple Support Declaration be used? Well, Form 2120 is used in a situation when 2 or more persons, each of whom would be able to take a qualifying person's exemption except for the fact that they fail the support test. Together, these 2 or more persons have provided more than half of the qualifying person's support, and at least one of those persons provided more than 10%, but less than 50% of that person's support. So let's say you have a mother who is being provided by her 4 children. You have one of the children providing 30% of the support, another child providing 40% of the support, and then you have 2 that are providing 15% of her support. All of them provided at least 10% of the support of the mother. None of them provided 50%, so who gets to take the dependency exemption? This form will allocate who is going to take the dependency exemption. What happens if the parties will not agree on who will be allowed to claim the exemption? Well, in IRS Pub 17, page 35, Multiple Support Agreement, it does not specifically say that no one can take the exemption if an agreement is not reached. However, it does say Form 2120 must be signed by all persons relinquishing the dependency exemption, and the form must be attached to the return of the person claiming the exemption. We therefore conclude that if no agreement is reached, that the dependent can be claimed by no one. What requirements must be met to use Form 2120? Well, We've already said that more than half the support of the qualifying person must be provided by 2 or more individuals who are related to the dependent or have lived with the dependent as a member of their household all year. So if you remember the relationship test, it says that a qualifying person, if they live with you all year long, then they meet the relationship test. But there's no one person providing more than half the support individually, and at least one person provided more than 10% of the support. So who attaches Form 2120 to their return? Well, the answer to number 3 told us that the IRS says that the person claiming the dependency exemption must attach Form 2120 with the signatures of all others releasing their claim to the exemption on the form. So who is a custodial parent? A custodial parent is the parent that's named in the document of a divorce decree or court decree awarding custody of the couple's child. If there is no such document, then custody belongs to the parent who had physical custody for the greater part of the year. Number 7, which parent can claim the exemption if there is no written agreement or it is not stated in the final divorce papers? Well, if you look at IRS Pub 17, page 28, custodial parent and non-custodial parent, the parent with physical custody is entitled to the exemption provided he or she meets all the dependency tests. If support is provided by the non-custodial parent through child support or spousal support payments, these payments are considered to be support provided by the custodial parent. Support is just one of the dependency tests. A non-custodial parent can only claim a child's exemption if the exemption is awarded in a divorce or separation instrument, or the non-custodial parent releases the child's exemption by signing Form 8332 or a similar statement such as a divorce decree, saying that the non-custodial parent may claim the dependency exemption. Number 8, pretty much what we've already talked about. A non-custodial parent is only entitled to the dependency exemption if he or she is so authorized by a divorce decree or other court document, or if the custodial parent releases the dependency exemption by signing Form 8332. Describe the purposes of Form 8332. So Form 8332 is used to relinquish a dependence exemption to the non-custodial parent. Number 10. Okay, so here was the first tax return of this tax course that you prepared. Let's get the tax return for John Sanders and Maggie Sanders up here, and let's take a look. Okay, so it says John Sanders is married to Maggie Sanders. They reside at 2222 Northeast Mississippi Highway, Aloha, Oregon, 97008. John is a manager and Maggie is a custodian. Their W-2s are attached. The Sanders have 2 children living with them. Their son, Mark, gives his Social Security number and his date of birth. Dates of birth are very important on a tax return because they will tell you, based on age, if there are any special amounts that can be taken. There are credits, there are special exemption amounts, as we learned in Session 1, and there are a number of credits that surround children, and most of them are based on the age of the children. So you always, one of the first things you want to do when you do a tax return is figure out how old all the people on their tax return are. So you can keep that in mind when you're preparing the return. So they also have Maggie's nephew, Jerry Stevens, living with them. He has lived with the Sanders since 1999, and they provide all of his support. Okay, so let's take a look at this. We've got married filing joint. Both of the spouses work, so they're each going to have a W-2. 2 children. Mark, their son, was born in 99, so 2012 minus 1999, we come up with 13 years old. And then we have Maggie's nephew, Jerry Stevens, who was born in 1995. So 2012 minus 1995. And we come up with 17 for Jerry. Let's take a look. So first off, as we've talked about, we have married filing joint. We've got both Mark on the return and Jerry on the return. We put their social security numbers. One's a son and one's a nephew, so that's the relationships that we're going to put on the return. We have in column 4, check if a child is under age 17. Under age 17, there's one of those credits that's going to be contingent on a child's age. Go over here to boxes on 6. We've got 2 checked here, one for Maggie and one for John, and then we have 2 checked here for the 2 dependents that lived with them. So we have a total of 4 in box 6C. Wages, salaries, and tips on line 7. We add up what's on the W-2 for Maggie and John and put the total in here, which from what we can see from their W-2s, we have 19,000 here for Maggie. You add those 2 together, we get the 51,000. We don't have anything else going on the front page of their 1040, so we will move over to page 2 of the 1040. Okay, and so we bring that 51,000 over here to the adjusted gross income line 38, 51,000. Take a look at whether they're going to itemize or use the standard deduction. You were not given any amounts for itemizing, so we're going to use the standard deduction. And as you can see here, married filing joint, standard deduction 11,900. So that's how we arrive here at the 11,900. Subtract that from the 51,000, gives us 39,100. And then exemptions. And it says here, multiply the exemptions on line 6D by $3,800. Well, we figured out that they had 4 different exemptions on line 6D, so 4 times 3,800 is 15,200. We subtract that from the 39,100, and we end up with taxable income of 23,900. So if you were to go to Pub 17, the tax tables, and look up the amount for married filing joint, income level of 23,900, you would come up with tax 2,719. But then let's take a look at what we have here. We've got this $1,000 amount for a child tax credit. Remember on page 1 we were talking about how we checked that box for Mark, and Mark is under the age of 17, so he qualifies John and Maggie for a child tax credit. And that child tax credit is $1,000. We enter $1,000 on line 51. That's a subtraction from the tax. So their tax now has been reduced to $1,719. So let's take a look at what John and Maggie had withheld from their checks. So federal income tax withheld for John was $1,500. For Maggie was $1,500. You add those 2 together and put them here under line 62 of the 1040, and we have $3,000 withheld. $3,000, of course, is more than $1,719 that we've determined that they owe, so they will be getting a refund this year in the amount of $1,281. Well, that's our classwork review for session 2. You should now complete your homework, complete your reading assignments, and take your quiz for session 2. After you're done with that, I will see you in session 3.